in 2015. Literally 10 years. Okay, 5 years, 14.5% a year. 10 years, going all the way back to 2015, 16.78% annualized. Annualized. Do you know what Vanguard told me the returns were going to be in 2015?
I would say 6%.
6%.
Yep.
That's exactly what they said. They said returns, you know what it always is. It's always, well, past returns have been above average and eventually returns average out.
Yeah.
So future returns are going to be below average. And while I don't disagree with that, it's like, how do you get there? Right? We've talked about this before on this podcast. Back in the 60s, I think it was, there was an index called the CRSP index, the CRSP index.
Yep.
It was created essentially with the intention of helping advisors demonstrate the importance of long-term investing to their clients. So they went back and built this index to track all these stocks, and then they tried to figure out what was the annualized performance of this basket of stocks that we're simulating. And what they found was that over the 60 years leading up to that point, you know what the annual return was? 10.5%. Okay. Now, more closer to present day, we have more data, right? So the question 60 years later was, well, how do returns look since then? Okay, so we went and measured the same thing from the point of the original study on 60 years later. Do you want to know what they found the average annual return was?
10%.
10.5%.
Yeah.
Right?
Yeah.
It's amazing. Now, along the way, there were all sorts of bad things. You know, just because the average annual return is 10.5% does not mean that you can expect 10.5% every year.
Yeah.
And that's kind of the point of what we're here to talk about today.
Yeah. Well, one of the biggest voices out there in the investing space is Dave Ramsey. You know, every financial advisor hates Dave Ramsey's input on this. His opinion is that you should be getting 10 to 12% of returns on your what he calls growth mutual funds. And I actually looked it up through he puts his money where his mouth is. Because he does invest in these mutual funds, but also too he puts it out there on his website where he talks about this 10 to 12%. The problem I find is that advisors don't. It's not that they don't agree with it. It's that it sets up improper expectations that you're going to get that annualized. And it even says in his blog on the website that that's not the case. In fact, they mentioned the lost decade. But one little tidbit I didn't quite know that he talked about is, the return and the S&P 500 from 1990 to 1999 is 19% annualized. So you think 16% is great. That's pretty good.
I mean, there are people forget that when you take 10 years and put zero return on it, you can have good returns before and after it and still average out to pretty average returns.
Well, in today's episode of the Money Alchemist podcast, we're going to unpack this concept of lumpy returns and why some people's returns are kind of garbage. There's a lot of folks out there. There was that J.P. Morgan Guide to the Market stat for years that was the average investor return. Remember that stat? The average investor return. For years, it underperformed inflation. I actually think it's picked up since then. So let's see if we can find it. But before I dig into that, I guess we need to introduce ourselves. I'm Ben Jones.
And I'm Brent Gargano.
Yeah, and today we're going to talk about terrible returns and how to remedy that.
Well, I think what we're really here, I think there's a lot of times where clients look at you as the advisor and say, what kind of return should I expect? And we have a lot of software and voices. I'm sitting here looking at a Vanguard study on what the forward returns in the market should look like and whatnot. There's all this pontification on, what to expect for forward returns. But in reality, even when you get good or bad return, returns are lumpy.
Yes.
And trying to, I remember being at Fidelity and taking phone calls where somebody would say, my goal is to make 10% per year. All I want to do, it just sounds so easy, right? But while the stock market, as we talked about before, has historically returned, let's just say somewhere in the ballpark of 10.5% per year, there were years that were down. There were years that were up a lot. The returns are not, it's not like a straight line.
Yeah, in fact, there's entire decades where there's the infamous lost decade, 2000 to 2010, where large cap stocks, as represented by the S&P 500 Total Return Index, did absolutely nothing. They spun in the mud. That wasn't the only time. You also can look at 1965 to 1975. You can look at 1929 to, heck, I think it went all the way to 1943 before the S&P 500 was at break-even points. So, you in order to get these high above average returns, when I mean above average, I mean above the average return of the average investor, you almost have to have a superhuman-like resilience. Your temperament has to be rock solid. The term out there is diamond hands. And here's some information. I want to get your thoughts on this, Brent. So right now, we get these messages like this post from Brew Markets. I don't know who this person is, but it came up in my X feed this morning. And it says, the Shiller PE ratio just hit 40 for the first time since 2000. The implication being that stocks are overvalued. So what's your takeaway from this? What are you going to do with that information?
Yeah, I mean, it's so hard to time markets.
Mm-hmm.
I mean, I wrote about this in my newsletter last month, and I looked at the 1990s bubble.
Mm-hmm.
I think a lot of the clients right now are I don't want to say there's definitely a lot of fervor out there where we're comparing like what's happening today with AI and a lot of the strength that we've seen in markets recently, and like tying that to the 1990s and the dot-com bubble.
Yep.
That crashed in 2000.
Who's heard of the comparison between Cisco and NVIDIA? I've heard that comparison nonstop.
Yeah.
Mm-hmm.
And so it's not to say that PE ratios aren't relevant, because they are. I mean, we have this chart here from JP Morgan. JP Morgan has a good resource called the Guide to the Markets, and they have a chart that shows the price to earnings, which let's simplify this a little bit. Price to earnings is I think we throw that term around like it's really easy to understand, but what it is you take the price of a stock or of an index or whatever it is, and then you look at, well, how much, like what are the profits on a per share basis for that company or whatever it is, right? And so if a stock is priced at $20 and earns $1 in profits per share on an annual basis, then its price to earnings ratio is 20.
Yes.
Right, because $20 is 20 times $1. And it kind of represents if earnings weren't to grow, like how many years does it take to get paid back your money? And what you're doing by paying that $20 is you're paying the present value of all of those future earnings. You're kind of making some guesses as to what that dollar of earnings does next year, 5 years from now, 5 years from then, and you're trying to figure out like what's that worth today.
And emphasis on the word guesses, because that's exactly why these stock values change, because those guesses change.
Well, and this is, this is really more paralleled right now with like the labor market. I think people forget when you have ratios that there is both a numerator and a denominator.
Yep.
And so, you can bring a price to earnings ratio down in two ways. You can either bring prices down or bring earnings up.
Yep.
Right. And so like we're just pulling this to the economy today, like people are stubbornly frustrated with like the unemployment rate. Like there are a lot of people I talk to are kind of, you see AI and you see like jobs markets deteriorating, but the unemployment rate's still relatively low. And it's because guess what? You have jobs available relative to people that are looking for jobs. And we've done, for better or for worse, I don't care what your opinions are, immigration has just significantly slowed. And so the labor pool, the denominator, isn't getting as big as quickly.
Plus, this may be anecdotal, but I see a record number of baby boomers retiring. I've had more.
The denominators get, so back to the price to earnings, price to earnings ratios being high. I mean, some of the, I'll never forget, this was 3 months after COVID. It was like June of 2020, and everybody was screaming about how high price to earnings ratios were.
Yeah.
And In COVID, earnings plummeted. We shut the whole world down. So of course, price to earnings ratios went high, earnings went down. And when denominators go down, the number goes up. What people missed is that after you have contractions, the earnings don't rebound slowly, right?
Yes.
Earnings rebounds are quick. And so back to the question you were asking, like, what do you make of this high price to earnings? If you look at the data from JP Morgan here that we have up on the screen, over a 1-year basis, it's really hard to take a price to earnings multiple and predict what stocks are going to do.
Yeah.
Much more powerful of a relationship over longer periods of time.
Yeah, and the scatter plot, which we did link this chart in the show notes for those who want to follow along there, but in the scatter plot, the 12-month rolling PE ratios have very little correlation to returns over the next 12 months. Whereas if you average that out over 10 years,
5 years.
5 years. Sorry, 5 years, you begin to see a trend line. You know, the correlation becomes much more clear. Now that said, one will notice that we're very high relative to historical averages, and I do want to comment on this real quick because it feeds into our a later discussion we're going to have on the Vanguard capital market assumptions, and that is. P ratios I have observed in my career have been melting higher. Now with volatility, just like stocks, like there was a massive spike in valuations in 2000, which we actually have not yet replicated. That spike is pretty clear as a bubble. But since 1979, somewhere around there, you've just seen P ratios going higher and higher and higher, the averages of them. And what that informs me is that there is a monetary premium being priced in stocks. So for those who don't know what monetary premium is, that is basically the value of something as it relates to its exchange value. For example, that like your paper dollar, let's say it's a $100 bill, has very little actual worth. What do you think What do you think a $100 bill is worth? It's no more than the piece of paper I'm holding in my hand. You know, it's a couple pennies at most, but it's worth $100. That $100 represents the monetary premium of that asset, and stocks have a similar monetary premium. So there's an exchange value, and what's happening, I believe, is we're seeing an increase of money supply. You know, there's just a lot more dollars flowing around in the system. Think of it as you take a rubber glove and you're blowing air into it. If no new air blows into that rubber glove, it stays the same. There's no inflation. But if you keep blowing air into that glove, what happens is everything inflates. The palm inflates, the fingers inflate. These are assets. That is what's happening. And I think it's going to continue to push the P ratio higher. Now, I'm not. That's just my opinion. That's my analysis.
Well, let me push back again. I don't. Back to my point. I don't think PE ratios have to go higher for stocks to move higher, right? And I think again, the point here isn't to try to time markets. It's very hard to call market tops. So like trying to play this game of, well, AI is really hot and the market's done really well. Eventually, I think we're gonna be at the peak of a bubble and we're gonna see a big decline. So the scariest part is then saying, so I'm going to get my money out of stocks and wait for that.
Yeah.
Because being early is a lot of times just as bad as being wrong. I went back and looked at the 2000 crash and how long you would have had, like if you were invested since when, how long would you have had, how long prior to 2000 would you have had to invest so that even after the bubble you were making money? And even if you had invested your money in 1997, you still at the bottom when the market crashed, you still had more money than you started with, right? And I saw some stat, don't quote me on this, but recently, because there's been a lot of talk about this in the advisor community recently, and so a lot of people are trying to quantify, well, if it is like the 1990s, what year are we in right now?
Yes.
And I think that I heard that, and this is all guesswork, right? I mean, you have to kind of raise an eyebrow when you hear any of this. But somebody said that based on where we are in the economy today and all of this, we still have another 50% to go in the market higher before we have a correction. So who knows, right? I mean, the fool's game in investing is trying to predict the market in the short term. What we do as planners, and we've talked about this time and time again on this podcast, is the best investment for you is the one that you're going to stay invested in.
Yep. Mm-hmm.
Right? Because inevitably what happens is any of these investments, if it's not something that's, quote, safe, and by the way, the safe assets get beaten up by inflation, so they're really not as safe as you think. When you buy any kind of risk asset, like there's going to be times where it doesn't give you that average 10% return.
Yeah, and you'll feel terrible. People are allergic to short-term, very acute pain. They want to paper it over. They want to avoid it at all costs, because I don't care who you are. If you have $1 million portfolio and in 1 year it's worth $600,000, that feels like you're an idiot. It does. There's just no way to avoid.
Good.
And people just want to avoid that at all costs, and I can't blame them. But what we are telling you is that you have to ignore that. Now, it's important to note that if you are investing $1 million and the next year it's worth $600,000, but everybody else is worth more than that you got a problem. So what we're talking about is a broadly diversified investment. Like, let's say the S&P 500. So if you're in the ship with everybody else and everybody else is in the same ship, and it happens to take a turn for the worse, your best bet is just to hang on.
Yeah, forward returns. I mean, I think you make a really, really important point, which is that on a diversified basis, the lower the market goes, the higher the forward returns. And you can't compare yourself to some arbitrary average annual return. What you do need to think about is, how do I compare to the broader market?
Yes.
Right? And so there's going to be times, I mean, I was just looking at the data, just trying to put some numbers to this. I mean, we've just had a fantastic market over the last 10 years. It's 16.5% returns on an annualized basis from 2015 to 2025. And it's so easy to just forget that along the way, I mean, we had multiple drawdowns. 2018, I mean, Christmas of 2018, I remember working, it was basically 2018 was characterized by, it was Trump's first term in office. Summer of 2018, we had this big trade war with China.
Yep.
All these tariffs got slapped on, and then we had a midterm election. And just leading up to the midterm election, the market was just getting beaten up. I mean, it was like you couldn't win. It was like 5 months. I mean, I think from like July until December, it was just a grind lower, right? And I can remember the bottom of that market. It was Christmas Eve. I was working at Fidelity, and a guy called in and freaking out over how much money he had lost. And we built this plan and said he was going to be okay. And he asked me, what should I do? And I said, go spend Christmas with your family and stop worrying about this. Stay invested. And I just say that because, like, I've been working that whole 10 years, and I can't tell you how many calls and conversations I've had where people had lots of seemingly legitimate reasons to be nervous about stocks, right? Yet along the way, we've seen a 16.5% annualized rate of return, right? And like, I'll just point out again, just picking on certain years here, in order to see that 16%, you had to sit through, I mean, one of the easiest years to pick on is 2022.
Yep.
The market itself was down almost 20% in 2022. So had you invested $1 million, you were down almost 20%. So if your goal is to make 10% a year, what do you do with that?
You keep it invested. You don't get cute with it. So I think that the number one cause of people having poor returns is, well, I guess the reason behind every situation where there's terrible returns is a person that doesn't quite understand, market mechanics and how they tie into your overall financial goals. So when it comes to investing, you really need to link your mind with, your time horizon. I think people, they want to take their whole investment nest egg and look at it once every year. And it's important to do that just to reassess your goals and make sure that you're allocated appropriately. But you should not be doing that to try to, goose returns. I'll give you an example here. You brought up 2022. There's been many client conversations that you and I both had where people would call in. They say, "What do I do?" It's like, and our first question is, "Well, are you going to be spending the money? Do you need it now?" If the answer is no, then your answer should be you do nothing. Let's make sure it's properly diversified. Let's make sure your asset allocation looks good and it's aligned with capital market assumptions, reasonable capital market assumptions, which I do want to get into, and that it's aligned with your time horizon. And the truth is, Brent, has there ever been a 20-year period where a diversified stock portfolio has lost money?
I think the statistics are that if you look at history, if you're more than 7 years out, you've got pretty much as 7 years, I believe, has 100% chance of positive returns historically. I think your chances go down a little bit at 8 and 9 years because of that lost decade. But over 10 plus years, there's not been a situation historically where you've lost money. And actually, depending on the client and how comfortable they are with things, you could actually look over 3 to 5 years. There's very little situations where there's actually been negative returns over 3 to 5 years. So a lot of times for clients, what we're really focused on is making sure that there is, let's say, 3, 5, 7 years worth of, fixed income or lower volatility investments, so that in the event that we get some kind of massive market meltdown, you don't have to sell your stocks. You don't become a forced seller.
Exactly.
But, that same token is like, okay, I'll give you a great example. This year in April, we had a 20% market sell-off, okay? Market was still higher than, let me retweak my chart a little bit here.
You're talking about this period from, let's see here. From April. Well, that's
from April of this year to the lows. The market this year was down like 20% right? And of course, clients, if they needed money at that moment, were going, "Gosh, I know I'm not supposed to sell low." But if I look at the chart here, really, even if you sold at that down 20% number, the market was still higher than it was back in March of the year prior.
Yes.
So sometimes it feels bad to take a 20% loss in the short term. And I'm not saying that it's great to sell stocks at the 20%, but as long as you've owned those stocks for more than a year, you're still better off than had you shoved that money in. Had you proactively thrown that money in cash or bonds or whatever to say, well, I'm going to need it a year from now, and so I want to make sure I don't have to sell stocks down 20%, you still would have been better off selling stocks down 20%. So, I have one client I'll kind of pick on. They know they know I pick on them. I've got their permission to do so. They actually don't believe in keeping emergency savings, right? And I kind of laugh, but it's like it's worked out so well in the sense that his belief is if I had $50,000 in my emergency savings account that sits there dead for 20 years, I could instead take that money and grow it. And by the time it goes down, it will have doubled or tripled or quadrupled. And so I'm still going to have more than $50,000 of dead money, even if I have to sell it in a down market. And, this is why investing is so personal, right? Because I think somebody with that attitude, as long as they have enough funds to where, you could lose 30%, 40%, 50%, and you still be okay. Like, you can afford to think that way. And it's actually worked out really well for that person. So I'm not here to judge it, but you just have different shades of people. And some clients, it would totally freak them out not to have that security blanket. So again, with the goal in mind of being able to help you stick it out when things just aren't so fun, it's like sometimes you own the bonds, you own the cash, not because it's like better, but because it helps you sleep at night. And so that helps the rest of your portfolio do what it needs to do without driving your anxiety when it shouldn't be.
No doubt. What do you do, though, when you got a company like Vanguard telling you in their, as they did in the Vanguard Capital Markets Model Forecast published July 23, 2025, so not so long ago. They basically just said that U.S. equities, where was it? Here we go. U.S. equities are expected to return 3.3 to 5.3% per year for the next 10 years. What do you do with that?
It's so funny because these big institutions, we give them so much quote credit for like what they supposedly know about investing. And I can tell you, having worked for a lot of these large institutions, they have no clue. Right. I mean, I watched a previous company invest in international stocks for 20 years on the basis that, well, they're cheaper than U.S. stocks, so the forward returns are going to look better. Tell that to the client when you're looking back at a 20-year portfolio return that's like 3% a year when U.S. stocks have done 10. Right. So I think I'm somewhat cynical about this, and maybe they're going to be right. I certainly run financial plans in a way that if they were right, like my clients aren't going to be stuck.
Yeah, I think that's what's inspiring these numbers is they would rather be wrong and you oversave than for them to be wrong and you undersave.
Kind of like Dave Ramsey, right? Dave Ramsey likes that he can say, well, your investments are going to earn 12 and inflation is 4, so you can withdraw 8. And it's like that simple. And, 8% of a withdrawal, like I think any advisor that you talk to would not be particularly...
they would recoil at that.
They would not love their client. Like as an advisor, you want your clients taking, let's just paint with a broad brush, let's say 3 to 5% of their portfolio per year, depending on their age. It gets a little bit better as they get older. Things are a little bit more certain. But, it's so much more fun to talk about what somebody can spend if they get 12% a year.
What's interesting further about this Vanguard study is that there is not a single asset class that they're forecasting has a return over 10%, which shocks me because what do you think is going to happen with this deficit issue that we have? What has been happening for 25, 30 years? Our governments globally.
Everybody around the world is just printing money.
Exactly. Have met every single quote unquote crisis with a massive degree of fiscal and monetary stimulus.
Every time
that leads to asset price inflation.
Every time something bad happens, we turn on the printing presses, we send a bunch of money out, and when there's no additional shares of Apple created, but there's a 20% increase in the amount of dollars that are out there chasing Apple. Surprise, surprise, the stock goes up. And so I just, again, I'm cynical about these returns because I also wonder to what extent is this just like saving face from what they had 10 years ago? Because 10 years ago, they used to say the same thing. U.S. equities were 6. I can't tell you how many articles I remember reading when I was like in my 20s about how the 4% withdrawal rule is dead and interest rates are really low. And so stocks aren't going to do very well moving forward. And and we sit here, and so Vanguard used to tell me in 2015 that 10-year returns were going to be 6%. We just looked at them; they're 16.5. So how much of this is like doubling down on like, holy cow, we got it so wrong over the last 10.
They're like chasing a call or something.
That like if we want to save any kind of face, we just have to make it even lower.
It gets a little better when you look at J.P. Morgan's 2025 long-term capital market assumptions. Now, J.P. Morgan is the largest bank in the world, I believe. It's definitely the largest U.S. bank, but I think it might be the largest bank in the world in terms of total assets under management. But they produce this thing called their long-term capital market assumptions, which most financial planning tools leverage to forecast in what they call their Monte Carlo analyses. So bottom line is these are important assumptions. So just like we all take for granted the 3% average rate of inflation, well, we also have all other sorts of assumptions built into financial plans too, like future returns. So JP Morgan, they do a little bit more thorough analysis. For those who are following on video, you can kind of see, but we put this chart in the show notes. It's a little bit dense, but
I'm not sure who wants to see this chart.
but basically the same thing exists. There's a few asset classes that that forecast returns over 10%. For example, U.S. value-added real estate, interestingly, they have an optimistic view on. But for the most part, we're looking at mid single digit returns for U.S. equities and fixed income. So
it's like such an easy prediction to make. It's like, well, we know they're going to be positive. We think returns have looked really, really good the last 10, 15 years.
Yep.
So I don't know. Let's pick a number between like, say, 3 and 7 and just call it a day.
Yes.
Right. And that's kind of what it feels like they do here.
Yeah.
You know, because it's
exactly
just,
right.
it's like a lazy answer. So again, I don't, when we build financial plans, we have to, like, I don't want a client's financial success to hinge on us continuing to have 16% compounded returns.
Yeah.
Right? Like, there's no way in my right mind I'm going to build a financial plan that relies on you making 12, 14, 16% a year. That said, it is incredibly important to recognize that while there are always reasons to be pessimistic about the future, over time, it has been massively profitable to be an optimist.
Oh, for sure. Yeah. So what do you think this does, though, when it informs other advisors and older folks? Like, I do want to touch on this because we do see this trend a lot where, you know, we'll have some younger clients, maybe they're millennials, Gen Zs, and they come to us and they say, my parents' returns suck. You know, I looked at my mom and dad's financial statement, and it's just, you know, they're just spending in the mud. You also see this with folks who just save their whole lives. They put their money in these 401k plans, and they choose the default investment option, and they just don't ever talk with anybody. So do you think these capital market assumptions inform financial professionals improperly to the point where you've got a whole generation of investors now that are misallocated?
Well, to me, this is maybe a slightly different topic in the sense that what we're really thinking about is like, how much of your money can you put in stocks?
Yes.
And a lot of that is driven by like, how much volatility can you afford? And how much volatility you can afford kind of depends on like how much of your money you need. And what I think is there's this kind of conventional wisdom that the older you get, the more conservative you should be. And I don't know if that's really true. In my mind, you almost have to be the most conservative right at the point that you retire, because you basically have the longest time horizon. Like if you retire at 60 and we run a plan to 95, you have 35 years of uncertainty. And there's a lot of data that would support that the first 5 years of your retirement drives a lot of the next 30. Because if the market goes down in the first 5 years and you're selling out of your stocks, you just do a lot to hamper the next, you know, few years of returns versus if the market does well. So to me, the point where you kind of almost want to be most conservative is right as you retire. And then as you get older, you get further in life, you kind of, I mean, what's so interesting about a financial plan for a 95-year-old is it kind of either works or it doesn't. Yes. Right? Like you kind of know where the plan is.
You're at that point where you know that the fat lady has sung, so to speak.
So if I have a 90-year-old client, right, and they have $3 million and they spend $200,000 a year, like they have 15 years of money, you know, and that's with no growth. And they could even probably afford their rest of their life, even if the market lost 50%. So I think there's just this interesting, maybe second degree question of like, okay, great. What kind of returns can I expect? Really, that's driven by how you're allocated, like how much of your money is in stocks versus bonds. I think we're over time always likely to see that stocks will outperform bonds. So if you don't need your money, or that money is designed for future growth, like what's the only point of owning bonds is to not have to sell your stocks.
Well, let's first define like what a stock is, and I would broaden the term to include equity, because you know, I think that is it's not just stocks that have produced outsized returns. It's also real estate, things that, you know, where you own. Equity just means ownership. It means you own the asset, just like the term home equity. You know, home equity is that portion of your home that you own that the bank doesn't own. So when it comes to equity ownership, you are quite literally owning that asset. So you own the full upside. You also own the full downside. And as you like to say, the limit to the downside is just 100%, right? So, but your upside is limitless. When it comes to bonds, you are a lender. Your best case is that you get your money back with the stated interest. That is it. It is a capped return, and it also has unlimited downside potentially too. But historically, because of securities, collateral, and insurance, there typically is a limited downside. I think when it comes to like a junk bond, the recovery rate is something like 60 to 80 cents on the dollar. But in the case of like a treasury bond, government just prints the money to pay you back. So it's important to define the differences between the two. Now, bonds and cash-like instruments are used as things that don't go bump in the night. And what a target date fund does, or a traditional like Harry Markowitz, efficient frontier style asset allocation, what they essentially do is the older you get, the more money you have in things that doesn't go bump in the night. So bonds essentially. And I think there's a fallacy in that. For one, the older you get doesn't necessarily directly correlate to your cash needs. For example, You mentioned the 90-year-old. So that 90-year-old, how much money are they really going to need the rest of their lives? Let's say they've got $5 million in a portfolio. Their worst case scenario is they go to a long-term care facility where they pay maybe $150,000 a year, half of which is covered by pensions and Social Security. So what is it that they're going to need? In reality, they're investing for their next generation, and that next generation has a longer time horizon than what fixed income offers.
And so, I guess the whole point here is that you can't look at how much risk you're supposed to be taking in a vacuum. You can't gauge your returns based on some kind of linear return expectation. You have to be, invested purposefully relative to your needs and your situation and your comfort with risk. And then you kind of have to be willing to take your lumps along the way and stick it out.
Yeah. So your balance between equity ownership and things that don't go bump in the night is balanced on two things. I would like it to be nice and neat for it to be balanced on one, because then we could call it a fulcrum. But no, it's balanced on these two things. First is your time horizon. The second thing is your temperament. Only one of which technically both. Time horizon you somewhat have control over, but sometimes not so much, because time you do want to achieve
Things come
goals.
up.
Yeah, you do want to achieve goals in reasonable times. Like no one sits down with us and says, Ben, I want to send my kids to college at age 30. So time horizon is somewhat controllable, but what's most controllable is your temperament and your behavior during down markets.
And your allocation.
Yeah. Well, your allocation should be informed by those two things.
Right.
So
give every dollar a job is kind of the we say in the industry. Now, we could go on for hours about this, but your willingness to be flexible around expenses is real. I might have a client that spends a lot of money, but let's say a lot of the expenses are discretionary and they don't have to spend it, and they're willing to cut it out if the market went through a bad period of time. They could take more risk than the other.
Well, I'm sorry to cut you off, but I do want to take a moment and let's look in the crystal ball real quick. Obviously no guarantees or assurances here, but what's the crystal ball telling us? JP Morgan tells us to expect 7, we'll call it, actually in U.S. equities, they're saying like 6% returns. Vanguard is saying less, about 3.5% on the high side. What do you think is going to happen over the next decade? Well, we'll expand it to 20 years. So,
the reason they think they say these numbers is that the better the returns look in the rear view mirror, the worse they need to look in the front forward mirror, right? If the S&P averages 10.5% over time, in theory, if the last 10 years has been 16% a year, the next 10 years needs to be lower. I think, like I said before, I think the fool's errand is trying to guess at these returns. I think what's important is controlling what you can control. For a lot of my young clients that are in their 30s and 40s, from my perspective as the advisor, I actually get kind of excited about the idea of 6% returns over the next 10 years, because what that would mean is there's some actual volatility. There's some like
buying
good
opportunity.
entry points for
Yeah.
the people that are in accumulation mode.
Especially if you're dollar cost averaging.
Right. And but like again, none of my 35, 40-year-old clients are going to like watching themselves lose money, especially over 10 years. It's going to like my job is going to be keeping them, consistent over that period of time. But if you go look at my clients that are 50 now, that were doing the majority of their savings between 2000 and 2010, like those contributions made them just a ton of money.
Yes.
Right. So it all depends on your perspective, and you remember your return is different than the market return because it matters if you're buying or selling.
Yes.
So my job isn't to predict the returns. It's to take what we're given and figure out how to take advantage of it, right? And so for retirees or other clients where they're, withdrawing from their portfolio, they're not buying anymore, we are hyper aware of running their financial plans in a situation where the market crashes like tomorrow, right? So we have a way in our financial planning software to run what's called a bear market test. And essentially what happens when I run this bear market test is it takes their portfolio and over the next 2 years, it goes through 2008 in the simulation.
So how many years do you like to have in liquidity, like a liquidity buffer to make it through that a standard bear market test?
I think that if you were to want, it depends on how much certainty you want that you're not going to have to sell at lows. But I think 3 to 5 years is a really that is a solid enough buffer to where you're not taking so much away from the stock's ability to produce as they go up, but you buy yourself. So for example, when, stock market went down in April, if I had a client that called and needed to take some money out, if we had a few years worth of bonds, just go grab it from the bonds.
Do you think that client that doesn't believe in an emergency fund is going to be convinced of that when he retires?
I don't, again, I that particular person has actually been very successful in their ability to have diamond hands.
Yes.
And I think that, they're just such a testament to, the power of being able to kind of stand behind your beliefs through challenging periods of time. And I would say that while in a textbook, I probably wouldn't write, go ahead and fully invest your emergency fund because it's probably going to be higher when it goes down than what otherwise. I think that if you have enough money, and back to if his emergency fund is big enough such that he could lose 50% of it and cash it all out and still be perfectly fine, it's controlled risk. So I don't know. I mean, it just requires context. And I would be willing to bet that person will have a hard time changing their tune.
No, I bet. Yeah. It's hard to shift gears.
People
like
that have been successful in their investment, it's just amazing when you see people that have been invested over the last 30 years. And these were not, to paint the picture of the last 35 years, the 90s were, I'll say great, but there were periods of decline in the 90s that we forget about. And then 2000 to 2010 was completely lost. There was no return for 10 years. And then 2010 to 2025 has been really, really good.
Yeah.
Right. And those people that were invested through that 30-year, 35-year time frame, it's not that they didn't see bad markets. They saw a lot of bad markets.
Yes.
But those people are looking down at their accounts going, holy cow, look how much money I have. Staying with it mattered. Right. And so it's great in some way because as the advisor, a big part of our job is just helping them stay invested. And these clients are more comfortable trusting the market because they've seen it. What makes me more.
And I think that's a net positive. I don't necessarily think that client of yours needs to make that shift. The goal would be to have a nest egg so large where if it went down 50% and you were still a forced seller in that environment, that it wouldn't impact your long-term plans.
Right.
So now I do want to opine a little bit about the future and how to help people create their own diamond hands, because I do see some disruption on the horizon, and I kind of somewhat understand what Vanguard and JP Morgan are getting at. What they're trying to suggest here is that we are in an incredibly disruptive period in the market, potentially. Now, I don't necessarily agree with their return projections. I'm much more optimistic than they are, and I think that there's incentive for them to not be. We discussed that already. There's incentive for these large institutions to not be optimistic. But one thing that is true is that our economy right now is potentially is definitely in a disruptive period, mostly due to AI. A lot of it through other innovations as well, But AI is incredibly disruptive, and there's what we also have right now is a very concentrated market. So I think I read a stat. Now you correct me if I'm wrong, Brent, but I think that the Mag 7 right now represent 40% of the S&P 500, which is historically high. So now a lot of that is pricing in companies that are believed to take the lead in this whole AI space. So they're assumed to have, they're going to receive the lion's share of the growth that's going to be caused by AI. And I think that AI, we talked about this at breakfast today. There's all sorts of these companies popping up. These third-party companies that are essentially taking AI tools like ChatGPT and they're creating like this niche job. What do you call it? Agentic AI. So basically,
they're just basically packaging
an agentic AI and upselling it at a higher cost. So I think there's going to be a lot of these types of companies that are born and die over the next decade. Also, we're going to see different training models. There's no guarantee that ChatGPT is going to be the leader 5 years from now. Bottom line is, I want to get into pontificating all this. I'm just saying now is a good time to revisit concentration. I think a concentrated portfolio has outperformed over the last decade, but it's going to be very challenging. I'm not saying the concentrated portfolio will not outperform moving forward, but it's going to be increasingly difficult to predict those companies that are going to produce those outsized returns. So I think now more than ever, it's very important to take a diversified approach to investing.
Yeah, I mean, I follow that, but like these returns that these places, like they don't account for certain things, right? Like, I guess what I am convinced of is, okay, price to earnings ratios are high. You can look at charts and see that, but how does that fix itself? And again, if earnings grow,
earnings growth, yes,
right, and earnings can grow because of productivity. And guess what drives productivity? AI, right? So if you want to think about what might happen to earnings over the next 10 years, you could surmise that price to earnings ratios could come down, earnings could come up, and the stock market could do fine.
Yeah, but you're not espousing that people, try to pick the 10 different stocks or assets.
Well, here's what's interesting to me about the concentration, and this does bug me, because when you value a business, there's really three things that drive the value of the business predominantly. You have size, you have margins, and you have growth rate. Like if you think about it, if you look at a business and you want to try to figure out how much should you pay for it, the three things that you think about are how big is the company, how much money do they make, and like what are their profit margins, and how quickly are they growing. And if you go look today at the companies that are the biggest, that have the highest margins, that are growing the fastest, a lot of them are some of these big, the Mag 7, so to speak. And I think that's what's so challenging right now is it's like, where do you park your capital? And I just think people have found a lot of, it's not like the 90s where a lot of these internet companies were little companies. I mean, you have juggernauts like Apple, Amazon, Google. These are companies.
Yeah, they have earnings to back up their market.
These aren't like fly-by-night companies. These are some of the most well-capitalized, strongest, highest profit margin businesses that have ever existed.
Yes, but they're also not immune to disruption. So, a lot of them are disruptors, but I think that it's easy to forget that Google at one time was a startup and that Amazon also was a startup. I do think that, to harken back to our episode on concentration, it's wise to concentrate in investing when you are an expert on that one topic. Usually the thing that we would recommend concentrating in more than anything is like your own enterprise, something that you have direct control and influence over. I think I don't necessarily, I wouldn't use the term unwise, but I would say it's risky to try to put, for example, all of your portfolio in like 5 different stocks, to say, oh, well, I'm going to pick Microsoft, NVIDIA, Palantir, and these high growth, very sexy names and just to put all my money into that. My point is that, yeah, that might work out for you. I can't predict where these companies are going to go, but because the horizon looks very disrupted by AI, the potential for these companies to get knocked off their high horse is simply higher. That's my only point. So if you're an investor that's looking for diamond hands, like obviously if you've got a high temperament for risk and you're just shooting for the fences and if you happen to not hit a foul ball that doesn't knock you off the plate, then keep going, keep swinging. Be Sammy Sosa. But what my point is most people do not have that level of temperament. So they need to have more stable like returns. And my suggestion would be now more than ever, be diversified. That's not saying you're going to get better returns. That's just saying that, it's going to be easier to hold on to that. So think about like we got Kings Island close by. My middle son, he would probably be embarrassed that I said this, but he will not ride Orion. He's fine.
I don't ride. I don't do any of those.
He's fine on the littler ones. He's great on the littler ones. But God forbid he ride Orion. Because it's just too exciting. There's just too much volatility. So I guess the message is to know thyself. Yeah.
Mm-hmm. Yeah, I think that's important, and also always look at your performance relative, to the broader scheme. If the market's up 20% and you're down 30, there's a problem. Yeah. Investing is so much about managing your emotions. You always want to put yourself in a position where you're both winning and losing at the same time. You always want to have good and bad, whether the market's up or down. I mean, it's just I used to have people when I would talk to them and they'd want to get all the way out or all the way in, and I used to say, well, what if you got part of the way out? And then if the market goes up, okay, you got some of it out. That's a bad thing, but you got a lot of it in, so that's a good thing. If the market goes down, well, okay, you got a lot of it in, so that's a bad thing, but you got some of it out, so that's a good thing. And just managing your emotions is so important. So if you can't, take the heat of essentially that kind of concentration on, if my portfolio is only large cap growth stocks and those go through a bad period of time, and I don't have those international stocks in there to say, well, at least I own international, maybe you should own some other things, even though there are periods of time, like I pick on international because the last 5 years, it's like if you owned international versus US, what were you thinking?
5 years?
20 years.
Yeah.
But now this year, international's picking up. So when the market was down at the beginning of this year, and I had clients that were looking to withdraw from their portfolios or whatever, it was nice to have a bucket in the portfolio that was up instead of down.
Yes. Right?
It's all about diversification. So anyway, I think we've beat the point up pretty well here.
Yeah, I don't think we have anything useful to add to the topic. Of course, we could always talk ad nauseum about return expectations and how this ties into financial planning and the importance of being resilient in your portfolio. I think we'll end on this quote from economist Richard Thaler. He was interviewed in 2020 during the COVID crash, in the midst of the COVID crash, and I forget who interviewed him. I think it might have been CNBC, someone on CNBC, and they asked him, what asset classes look good in light of this massive sell-off in COVID, and he basically said that you shouldn't even worry about that. The best thing for investors to do is to adopt a sensible allocation and stick with it. Adopt a policy of benign negligence. And I love that term, benign negligence. So be negligent. Don't look at your portfolio. Don't micromanage it, but benignly so. So don't be, don't ignore it to the point where you're abdicating your responsibility for your future self.
For example, how many retirement accounts have you seen where somebody rolled it over years ago, they shoved it in an IRA, and then they forgot to invest it?
I met someone, I know.
Don't do that.
I know, we're going long here, but I met someone the other day, just picked up a client where they rolled their assets into a DIY solution, and they did this 5 years ago. And do you know?
They never invested it.
Yes, it stayed in a money market account.
I can't tell you how many times I've seen that, and it's like how much money have I seen that's just been blown because somebody rolled a retirement account over 5-10 years ago based on some, they called in, somebody talked to them about rolling it over to an IRA. They put the money in the IRA, and then nobody came in and invested it. And then here we are 5 years later, and I see the account's in cash. And you don't even want to tell somebody what that cost them.
It's heartbreaking.
So it's not to say that it's like, investing isn't just like blindly pick something. It's important, like why, like in the portfolios that we manage, the things that we own with intention, we own with purpose, we know why we own what we own. At the same time, the key to being a successful investor is not being able to pick what's going to do well over the next 6 months.
Yeah. So if you lack clarity in your investment policy and your direction and your financial plan, or you just feel like, I sold at the wrong time and I'm buying at the wrong time, or you just simply feel that your returns aren't up to your expectations, then give us a call. All our contact information is in the show notes. So I know, Brent, you've got a great website at infinitewealthplanning.com. I represent National Wealth Management Group. Again, all our contact information is in the show notes. So I appreciate you listening, and we'll catch you in the next episode. Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.